Welcome to this class on liquidations. Now, liquidations is a section and a type of question which in the past I've always found that students really struggle with. But what's important for you to understand about liquidations is that there's nothing in liquidations that's really new. Yes, there's one section we're going to talk about, the dividend stripping, but it's actually not, that's a very minor part of liquidations. It doesn't even always feature, and it's not only linked to liquidations at all. So ignore that for now. For what I want you to think about liquidations, liquidations is a section that combines your knowledge of shares, dividends tax, and basic accounting. It's also a section that requires you to really understand the differences between taxable income, accounting profit, and cash flows. So you can't continue with this section if you've not yet mastered dividends tax and shares. Please, if you haven't studied those sections, you haven't mastered it, if any of those things are confusing for you, don't look at liquidations yet, because it will further confuse you and it will just turn you off liquidations in general. Be very careful about that. You can't understand it if you don't know those sections. Now, you'll see what I've done is I've broken down the liquidation process into the company's perspective, and I've broken it down into the shareholders' perspective. Please be aware of both of them. They can ask you both in one question, so you need to know what happens. Now, what is a liquidation? Let's just first talk about it. Okay, so let me actually show it like this. So in your statement of financial position, you have your non-current assets, right? So your property, plant and equipment. You have your current assets, cash and cash equivalents, trading stock, debtors, right? Then you have your equity and liability section, which is your equity. It's like your capital, retained earnings. And then you have liabilities, trade creditors, loans, and I'm going to add one extra one here. SARS, when you have to pay SARS, that's also a liability. Now, if you have this as a company, so this is your company's state of financial position, to liquidate it means you're going to take all of the assets of the company and you're going to sell it. You're going to turn it into cash, liquid cash, liquidation. You're going to then pay all of your liabilities. And then whatever is left goes to the shareholders. So, equity equals assets less liabilities. Now, it is technically possible when you do a liquidation there's two approaches. There's the equity method and the asset method. The equity method means you just use the equity over here, which we've got. And the asset method means you use the asset less liabilities. Guys, in reality, the equity method is used. It's also usually prescribed in exams. I'm not going to go into the assets method. It's never been used, and I don't want to include it there. Right, so we're going to use the equity. Now, basically what you want to do is your retained earnings over there. Once you sell off your assets, that is where it's going to end up in. So, what I want you to understand from the start, when we do a liquidation, so understand now what's going to happen. Let me actually go back to here. While the company is trading, that's what you've been doing this entire year. You'll calculate the taxable income, the tax as normal. So there'll be sales, and there'll be purchases, and there'll be wear and tear, and there'll be capital allowances and trading. So all of these normal things that you study, normal rules. Okay. Now, liquidation. So they tell you the company is being liquidated, so the shareholders maybe want to close the company, or whatever the reason might be, they'll tell you the company is being liquidated. Now, when a company is being liquidated, this is what I already discussed. Please make sure now the following. You will dispose of all of your assets. Okay? That's what I meant And I said here, you'll sell all of these assets. Now, when you sell those assets, when a liquidation doesn't change the rules. When you sell an asset, there's still recoupments and capital gains. When you sell your trading stock, there's still gross income. All of those normal rules apply. So when you dispose of your assets, you will still calculate normal taxable income and tax. That tax that you calculate when you now sell it will form this liability over here. So it forms part of your liabilities. You can't pay the shareholders if you haven't paid SARS yet. Right, so then you will pay your outstanding creditors. So what I want you to understand right now before I move on here, this part is what counts the most marks in the liquidation question. And this is the part that you already know. It's exactly the same as over there when the company was still trading. The only difference is the company is not trading and now selling its assets. So it's just disposals of assets. You all know how to do that. You all know how to calculate this final liability. So that's the first thing I want you to see. Because what the students do is they confuse step 1 and step 2. And they do some sort of weird mix and combination, and then that's when everything goes wrong. So your first thing that you're going to do is you're going to sell all of your assets, you're going to do the normal tax calculation. You are then going to be left with the amount which is available for the company to distribute to its shareholders. And that amount, you'll remember from when we studied things like dividends tax, if a company makes a distribution to its shareholders, that distribution over there can only be a dividend or contributed tax capital / a return of capital, if you want to call it that. That rule still applies. So when the company now pays out its final cash to its shareholders, it needs to see how much of that is a dividend and how much of that is contributed tax capital. And how are we going to determine how much your shareholders are going to receive? Remember, equity is assets less liabilities, so we are going to calculate our retained earnings balance. So that's a little bit of mix of accounting. Again, guys, very, very, very simple. So now, you see number 1 here refers to number 1 here, number 2 there refers to number 2 over there, okay, just so you understand what we're looking at. So number 1, we're looking at the liquidation. I've already spoken to you guys about it now. So this is basically the situation where you wind up, that's what they call it. It means you sell all of your assets and you settle all of your liabilities. Winding up the company means you are getting rid of all of its assets, paying off its liabilities, turning it into cash. So when you approach this part, you will form a normal tax calculation. All the normal rules, guys. Trading stock, recoupments, capital gains tax. All of those things are exactly the same as it's been. Right. Why are we doing this part? We're actually only doing this part for one reason, and that is to calculate the final liability which we owe SARS. Now, the distribution to the shareholders, like I said to you, it can only be dividends or contributed tax capital. Now, the calculation that you want to perform, opening balance plus accounting profit before tax less our tax payable. See here, this is the calculation that we're going to be performing. This is the important part. You have to be able to do this. Opening balance will be given to you. Accounting profit you will calculate. And the tax payable comes from number 1. So it's from this process where you calculate the disposal of the assets and how much money is left. This closing balance over here is split into 2 parts. It's split into a dividend and contributed tax capital. And this is what is paid to our shareholders. Now, they give you this format. They tell you need to use this format in an exam. I want you to see what this format is. It's exactly this calculation, which is the calculation of retained earnings. Opening balance plus accounting profit less your tax liability gives you the amount available for distribution, and this amount is actually your closing balance for retained earnings. Okay, and then you have to calculate if there's any dividends tax. This is just to show you'll calculate your dividends tax in that amount. So we split it here between 2 columns, contributed tax capital and reserves subject to dividends tax. So dividends tax. Because what are we basically saying there? It's again an application of this principle which tells you that when a company makes a distribution to its shareholders, it's either a dividend or a contributed tax capital amount. And that is exactly what we do in this calculation. We just split it from the start between contributed tax capital and dividends.